Hey everyone, welcome back to Financial Planning 101. So today I want to talk about a subject that for a lot of you in Australia are pretty familiar with, and that's superannuation. There are a couple of different elements to it. A lot of you will probably know that there are concessional contributions and there are non-concessional contributions, and your employer is obligated to put in a percentage of your gross income, which is at this point in time 11.5%. That will be increasing to 12% come 1 July this year, which is 2025. That forms part of the $30,000 concessional limit for this financial year. So if, for example, someone was to be earning $100,000, 11,500 goes in from their employer. That means that there's 18,500 remaining of unused concessional contributions for this financial year. Now, there's a little bit of an addition to that. If you have a super balance that's under $500,000 as of the 30th of June in the previous year of that contribution, meaning if we're in financial year 2025, that means 30th of June 2024. If your super balance at that point of time was under 500,000, then what that means is you're eligible to carry forward unused concessional contributions from a rolling 5-year period prior. So there was this carry forward concessional contribution provision introduced in financial year 2019. One of those years has rolled off, and so we've got a 5-year rolling period from financial year 2020. So we've got 2020, 2021, 2022, 2023, 2024. We're now in 2025. So that means at the end of this financial year, in a couple of months' time, financial year 2020 rolls off, and then financial year 2021 is the 5th year. What am I saying with this? What I'm saying is you're not necessarily, and again, this is not personal advice. I always, when I produce these videos, I do have a disclaimer in my description that this is not personal advice and that you should seek your own independent financial advice through a financial advisor, or do your own research, all of that and above. But yeah, that does mean that in that scenario, if someone was not maximizing the concessional cap over those 5 years, there will be unused concessional amounts, meaning if they wanted to put additional concessional contributions in, they're not necessarily bound by the current financial year limit. This might be really useful to someone who has an investment property or an investment that they've sold. They've got a rather large capital gain. It means that they're going to have to pay tax on that capital gain at their marginal tax rate, assuming that they've owned that in their own name. But it also means equally they've got capacity to try and reduce that tax bill by offsetting it through putting in a personal tax deductible super contribution. And if they've got unused concessional amounts, then obviously they've got more capacity to offset that capital gain as well. Again, this is where you would seek advice from an accountant. And this is not, I'm not really giving specific information, but there's other variables that go into that tax calculation at the end of the year. So this is just one thing to be thinking about. Clearly the trade-off of doing it is that once you put the money into superannuation, albeit it's a very tax-effective investment vehicle, you need to meet a condition of release before you can access that. And for a lot of people, that would mean they would need to get to age 60 and then cease a gainful employment arrangement. If they don't, it means they can access super, but it's more limited. So it would have to be through a transition to retirement pension, and the most that they could access is 10% of the balance as at the 1st of July in that financial year. Kind of digressing a little bit off the subject of concessional and non-concessional contributions, but that's the point, right? You put the money into super, there's always a trade-off. What the hell was that? Someone did not just hit me, right? No, I'm good. There's that truck over there. What else? So the concessional limit, the 30,000, that is comprised of, typically, if you're in Australia, your employer contributions that go in on your behalf. If you salary sacrifice into super, that goes towards the 30,000. And if you put money into super that you're claiming a tax deduction for, that goes into the $30,000 calculation for this financial year. The other form of contribution is the non-concessional contribution. So in this particular financial year, 2025, it's 120,000. And in addition to that, there's also the capacity to bring forward additional financial years from the future. So they call it a 3-year bring forward rule, which means you could effectively contribute up to 360,000 in this financial year if you haven't already triggered that 3-year bring forward rule in a previous financial year. So after the 3rd year, it rolls off and then you get that capacity back. There's also a rule around whether or not you can utilize all of those financial years, and that's based on how much money you've got in super. So I think if you've got over, I don't know the figure exactly, I'm sitting in a car right now, but if you've got over 1.68 million, something like that, then you're not going to be in a position where you can utilize non-concessionals. But I think if you've got under, I don't know, 1.48, you have to look into this one, 1.48 million, something like that, then you could potentially still utilize the 3 financial years. Why am I saying that? I'm just saying that because in a scenario where you want to put more than the concessional limit in, you do have the ability to put in a non-concessional amount as well, which is useful to people. For example, if they are selling an investment property and they do have significant proceeds and they want to allocate that to an investment and they're close to meeting a condition of release, then meaning they're, for example, close to being age 60, it wouldn't make a lot of sense to invest outside of superannuation because there would be potential tax consequences. Maybe not necessarily initially. Is that a Lamborghini SUV? Wow, okay, I didn't know they made those. But long term, if they were then to liquidate that and there's been a lot of unrealized capital gains, then that would crystallize that capital gain and means they would end up paying tax if they've bought it in their own name, for example, at their marginal tax rate. Whereas if they put it in super, they could have it in that accumulation super account with a view that they could then move that into a pension account and draw the money out as they need it, which would be tax-free. So again, not taking your situation into consideration, they're just some of the factors to think about. What else is there to mention? I kind of feel like that's the basis of it. So you've got the 2 forms, concessional, non-concessional. Concessionals made up of employer contributions, salary sacrifice, and personal tax deductible contributions. Non-concessional is money that's basically sitting in your bank account. You've already paid all the tax on it. So when it goes back into super, it goes into the tax-free component of the superannuation. So you do have a taxable and a tax-free component inside super. Wow, I've just been graced with a SUV Lamborghini, and now there's a Ferrari just driving by. This is not normal, guys, but it's very nice to see. I don't know what I'm saying right now, but anyway, super distracting. Concessional, non-concessional, taxable and tax-free. So when the money goes in through a concessional contribution, it goes into the taxable component. Now, it's not really that important to you unless the money is going to the estate. So if the money ends up going to the estate and there's adult beneficiaries, then there is going to be a state tax payable on the taxable component, right? So for someone who has just basically formed all of their value in superannuation through employer contributions and maybe some salary sacrifice, it all goes into the taxable, which means that if they were to in later life pass away and it doesn't go to the spouse, let's assume there is no spouse, because if it goes to the spouse, it's all tax-free. But let's assume there is no spouse and it goes to the estate and they have adult children, then there will be 17% tax paid on the taxable component. And as an example, let's say they've got $500,000. That means there would effectively be around about, $85,000 in tax withheld at the estate level, if it's all taxable component, which is that 17% of 500,000, which I think I've done my maths right there. again, by putting the money in non-concession, it goes into tax-free. So there is potential for a strategy later in life when someone is fully retired and they're still within the means of contributing into super. They could withdraw money from super and then recontribute that back into super. Now it comes out tax-free if they're in a pension phase, and then you put it back into super. It goes into the tax-free component, and over a number of years, effectively this could be a position where someone moves all of their taxable to tax-free, so that if it ever then goes to the estate, there's not going to have that same estate tax implication, if that kind of makes sense. So that's quite a common one. So there was rules introduced a few years back where they changed. I think it was previously when you were between 67 and 75, you had to meet a work test to put money into super, period. And then they changed that so that you could still put money into super as long as you're not claiming a tax deduction for it. So there was a big pathway there for people who previously couldn't put money into super because they were between that age bracket, and they had accrued a lot of money sitting in the bank account, and all of a sudden they could start to put money in. There was an opportunity to first take the money out and then put the money back in as well, which was a bit of a tax switching around. Or if they didn't have the money in super, there was an opportunity to put the money into super. I kind of feel like that's all I want to say around super. Actually, no. I don't know. So I mean, there's lots of advantages to super from a tax viewpoint, but I kind of feel like I just wanted to cover off on the contributions today. I'm just sort of running around in my head right now. I think that'll be it for now. I'm about 12 minutes in. It's probably about all you guys can handle, the two people that are now probably watching. So any questions about it, then leave a comment, and maybe in a future discussion I'll have a chat about the difference between investing in your own name versus superannuation and the pros and cons. I kind of feel like I've already alluded to it, but maybe I'll just drill down into the details a bit more. But yeah, that's it for now. Thanks guys, bye.